In this video, I'm going to be talking about how rising interest rates have been a cost and burden to individuals as well as businesses. Hi, Jim Gore from THOR Wealth Management. A lot of people see that interest rates have gone up, but they don't know what the impact is on individuals or on businesses. First of all, let's look at individuals. And one thing that a lot of individuals have, which they shouldn't have, is credit card debt. And this is looking at the interest rate paid for credit cards. And you can see here, this is from the Federal Reserve, that only a few years ago we were at 16%. Today we're close to 23%. So that's a 7% increase in interest rates. Well, that's a percentage. What does that mean in dollar terms? Well, in this chart, we're looking at the actual credit card balances outstanding. And what you can see is back in 2001, the annual interest rate interest costs that consumers were paying were $91 billion. Today, it's about $180 billion. So that 7% increase, along with the increase in credit card balances, mean that the interest cost for individuals is twice what it was just a few years ago. Now let's talk about businesses, okay? And this is, I think, a very good example. A lot of companies pay out dividends, but they borrow money to not only grow their businesses, but they also do it to buy back shares and increase their dividends. Well, let's look at these two companies. PepsiCo. If you look at Pepsi back in 2002, their total debt, their total long-term liabilities was $8.1 billion. Where are we their fiscal year ending December of 2022? They were at $48.1 billion. You're looking at $40 billion increase in debt levels, which is more than 5 times the amount of debt than what they had just 20 years ago. In 2002, they paid out 35% of their net income in dividends. Well, they've been increasing those dividends, which is great. Shareholders like that. But right now, they're paying out 70% of their income in dividends. If those long-term liabilities increase cost goes up by just 3%, which is in a lot of cases it's gone up more for corporations, but I'm using conservative 3%, and all things remain steady with the business, just that line item alone, Pepsi will be paying out 84% of their net income in dividends. Let's look at another one, stalwart here in Cincinnati, Proctor & Gamble, and this is their fiscal year is ending June. As of June of 2002, they have $14.3 billion in long-term debt. As of June of this past year, they had $38 billion, or we're looking at a $23.7 billion, or 2.7 times more in debt levels. Well, let's look at their dividend payout ratio. And P&G has been a little bit more conservative than Pepsi. Back in 2002, they were paying out 49% of their dividends of their income in dividends. As of the end of June of this year, it was 62%. And if interest rates go up by 3%, you're looking at 68% of their net income would be coming out in the form of dividends. Now, this is why you have to be careful with dividend paying stocks. You have to understand a lot of them use debt, raise debt, and then they pay out more in dividends. And this is why you've seen companies such as GE, AT&T, and Disney either eliminate or reduce their dividends significantly because they have to pay off debt. And if you have to pay off debt, the easiest way to do it, if to get money, is cut your dividend, use that excess money to pay the interest cost. And that is something that you have to be very careful with a dividend paying strategy. The last thing that I want to talk about is what is happening with businesses and loans, because this is an increased cost, but I really can't show what the cost would be. But this is an important chart because this is looking at commercial industrial loan growth over the last several decades. And what it's saying right now is that the loan growth is actually negative. And every time it goes into negative time period, usually that's a recession if you look at this chart. But why is this important? Because loan growth is stagnating because companies cannot pay the high rate of interest rates. And also banks are tamping down on loans that they're making. So when they do that, when loans aren't available for companies, what do? They don't grow their business like they did in the past. And that's why it usually goes into recession. So higher interest rate is a cost to small businesses right now because they're not taking the loans out as they used to. If you have any questions or concerns, as always, reach out to us at thorwealthmanagement.com. Look forward to talking to you in a couple weeks. Take care.